What's going on, YouTube? Stocks by the numbers, welcome back. Wanted to take a quick look here at Oracle Corporation, ticker symbol ORCL, listed here on the New York Stock Exchange. Got a handful of earnings coming out today after the close, but I know this is the one that everyone's keeping an eye on, so let's look into it. Let's see what's going on. So ORCL, 114.5, we'll call it. It's up about 2 points, 1.8% here on the day. The stock is about 13 points away from the 52-week high. Some people recently upped their price targets. In my opinion, we seem like we have kind of a mixed bag here. So I'm not exactly sure if I myself personally would be too confident going into this earnings play. But of course, it's Oracle. It's a brand name in the space. They're in the cloud. It's a tech stock. So I can appreciate the fact that everyone feels that tech is just going to consistently keep climbing and everything's going to be great. But let's get into it. So Oracle right here, 315 billion market cap, we'll call it. They're paying a dividend yielding out 1.42%. They're trading 31 times earnings. Been doing very well on the profitability side. In my opinion, that is really not the red flag here that's causing me to have kind of a mixed approach here looking at Oracle, because as we see, again, the EPS side has been pretty solid for the last several quarters. Looking annually, the company was holding that 39-40 billion mark for several years. And then, of course, we have hyperinflation and we're just moving more and more into the tech age. So if you happen to notice, coincidentally, all of these tech stocks have really taken off since 2020. And you can see the bump finally breaking out from the low 40s up to about 42.5 billion almost for 21. And then for 22, almost 50 billion. For 2023, estimates are north of 53 billion, so they're still basically on path for consistent growth. Of course, that profitability margin took a big hit, going from the mid-high 20s down to the mid-high teens, basically. But quarterly, looking year over year, technically the company has done well. And if you see even like Q2 of last year, 12.28 billion, and then you can see Q2 of 23, 12.94 billion, and the net margin obviously took a bump higher as well. So the company is technically increasing year over year, and recently the profitability side has been pretty nice as well. Going back to, looks like the middle of 23, you can see we're kind of in this downward trumpet overall. But just looking at some of these earnings, in my opinion, it just seems pretty inconsistent on the revenue side as of late anyway. Not bashing the company overall as a whole, but again, when a company has been staying up, even though the numbers aren't consistently climbing, then again, in my opinion, my biggest concern is the fact that markets are near these highs, and if they do begin to sell off again, something like this will absolutely drop down. Excuse me. You can see going back here, the company beats on the EPS and the revenue side. Then the next quarter, they beat on the EPS side and they miss on the revenue side. And then you can see next quarter, nice beat on the top and bottom line. This is what I mean. The profitability side has not been the issue, coming in 13.8 billion on 13.7. Very nice beat. Now next quarter, you can see beat on the EPS side, slight miss on the revenue side. As of last quarter, beat on the EPS side, slight miss on the revenue side. So this, in my opinion, seems to be a trend here. This company missing on these revenue estimates 3 of the last 4 quarters. So now you're asking yourself, well, if they missed and they went down, excuse me, how did they get back up? Well, it's because we're keeping markets at all-time highs, basically consistently, no matter what the heck is going on. And we've essentially been up almost all the time since we hit basically that Halloween mark. The markets, in my opinion, are way overinflated here. And that's why when I was calling during the summer months that we are due for a sell-off and the market should really begin to drop down and correct, we went into a 3-month sell-off. Then, of course, everyone just decides we hit the bottom. People wanted to talk about the Fed meeting. Like I said, people try to call me out when I give my analysis. And listen, if I'm wrong, I'm wrong. I'm man enough to own up to it. You guys know that. I go back, I hold my own feet to the fire. I don't even need you guys to do it for me. And I go back and I look at where I was right and where I was wrong. But remember, this whole rally at the end of October started. Again, we've been rallying for almost 6 months straight. Keep that in mind, right? Markets used to fluctuate. Now we've been up essentially for the last 6 straight months. But putting that to the side, the whole time that rally started was because they kept putting out these BS headlines, in my opinion, talking about, oh, Fed hinting rate cuts could be coming, blah, blah, blah. As I said, first of all, there haven't been any rate cuts, right? And every time they have a Fed meeting or they ask them about it or they come out and speak about it, they always say, oh, we're still cautious. We're not exactly sure when it's going to happen. Oh, but it could happen, down the road in the future. Okay, fine. But, just hoping that rate cuts happen and actually getting rate cuts are two extremely different things, okay? So for all you know, I don't want to go down the rabbit hole, but for all we know, again, all of this is unpredictable. It's out of our control. So for all we know, they could be talking about these rate cuts and markets could be continuing to climb. And for all we know, they can hike rates again. And then obviously markets should tank, right? But you can't even come to that conclusion because the whole time that the economy was going into the crapper and they were hiking rates, everyone took markets higher and kept bringing them to all-time highs. So, like I always say, if rates are hiked and markets go up, and you're saying markets should go up because rates are getting cut, I mean, you can't have your cake and eat it too, as they say. So something somewhere is going to happen, in my opinion, and these markets are going to break and sell off bigly. And the reason why it's going to be even more of a sell-off is because the rally went even more and higher and greater than it should have been, in my opinion. So coming back here again, we have a company that has missed earnings for 3 of the last 4 quarters. However, they are up very nicely here since missing earnings back in December. But looking here at these numbers here, estimates $13.286 billion on the revenue side. Last time estimates were north of $13 billion. The company missed by about $100 million in change. And I love that how some of these articles, it's funny because some of the stocks that we look at that I personally feel are growers, they'll mention like every little negative about the stock, right? And they'll try to justify it being kept flat or down or just, oh, it shouldn't rally and run as much as you think because of this, and this. Fine. But on the flip side, again, a company like this that has basically been consistently missing on the revenue side as of late, I'm just very surprised that they're talking so highly about it. As you see here, an hour ago, before the company even posted earnings today after market close, Citigroup raises their price target to 120 from 111. Maintains neutral rating, right? These price target changes usually happen after the company reports earnings. So we can look at that as potentially Citi may know something that we don't. But I wanted to, there was an article. No. There was an article that spoke about Oracle's capacity is an issue. Earnings need to show progress, according to Barron's. Again, Barron's is the infamous Barron's had the infamous headline saying that SMCI shareholders may want to may want to take profits on SMCI shares at 800. If you remember, that was Barron's a couple of weeks ago. But it says here, investment sentiment on Oracle shares has been cautious over the last few quarters, even though the stock is remaining stable, as the company deals with 2 primary issues. Oracle continues to see dramatic growth in its cloud computing business, which is growing faster than its larger rivals, Amazon Web Services, Microsoft Azure, Google Cloud, no problem there, but capacity issues have constrained growth. Last quarter, it didn't have enough data centers to meet demand. $28 billion acquisition, healthcare company. Yep, shifting the business to the cloud. But if it doesn't have enough data centers to meet demand and they've missed revenue 3 of the last 4 quarters, how can you keep the stock up? And I understand you might say, well, technically the stock's like been in that downward consolidating little channel for the last several months. Like, yeah, but we also know that usually when you have that technical lining up of that downward stepping consolidating channel, usually, after it reaches that bottom, it'll pop up and break out. So if this stock is ready to pop up and break out, in my opinion, it's doing so on false pretenses. The street will give a fresh look at progress on both fronts. Post financial results. Yes. CEO has projected revenue growth of 6 to 8% compared with the year earlier quarter, or 8 to 10% excluding Cerner. Calls for adjusted profit of 135 to 139. Estimates call for revenue of about $13.3 billion, up 7.2% with adjusted profit of $138 a share. For the May quarter, estimates project revenue of $14.7 billion. Oracle shares have been about flat since reporting November quarter results. That's not true. Selling off on the print, but gradually clawing back to post-report losses. The stock is up almost 8% for the year-to-date and 28% over the last 12 months. 28% over the last 12 months, missing earnings 3 of the last 4 quarters. That's very impressive. This is why, in my opinion, fake, overinflated markets are extremely dangerous for investors. If you buy into a stock like this now, in my opinion, up here at 114, 115, 120 after earnings, and then a month or two from now, we begin a massive sell-off and a massive correction, depending on the catalyst driving the sell-off, for all you know, it may take 2, 3, 5 years for something like Oracle to recoup those losses. And I know you might be ready to jump down my throat after you hear that in the comments section, but we'll look at the financials in a minute. I just want to let you know this stock right now has a book value of $1.40. Okay, keep that in mind. UBS analyst, who has a buy rating, of course, recently inched up his target on the stock to 130 from 125. Why? Why? Ahead of earnings, he checked in with various customers and industry analysts and found feedback skewed positive with no material red flags. The company has missed earnings 3 of the last 4 quarters, and you just said that last quarter it didn't have enough data centers to meet demand. Okay? We literally just laid out red flags. And this guy beefs up his price target, says that he checked in with customers and analysts, and found feedback skewed positive with no material red flags. I'm assuming that's a direct quote from this analyst. I'm not saying that. This guy's saying that. Okay, so even though we just established some red flags, apparently we have no material red flags. Found that Oracle Cloud Infrastructure may be discounting by less than people think against rivals Amazon and Azure, as the company has been working around capacity constraints reasonably well as it builds out more data centers. Okay. Analyst who maintains outperform rating, a 130 price target, says that after 2 consecutive quarters in which results disappointed the street, a clean inline quarter would be good enough this time to boost sentiment. This is what I'm saying, right? Isn't it amazing? Since when can an inline quarter be good enough to boost sentiment? That's not what we want to see. You don't want to see inline. You want to see above analyst expectations, with future guidance forecast higher than analysts previously expected. That's what we're seeing making a lot of these stocks pop and run over time. Again, we saw that with Dell. Technically, revenue is down year over year, but they come in above analyst expectations and they guided for increased guidance moving forward, giving a brighter outlook moving forward. That's why the stock popped and hit new highs. So how can a quote inline quarter be good enough this time to boost sentiment? This is what I'm saying. We're seeing a stock literally that has been underperforming analyst expectations. Yet, again, no material red flags. We're skewed positive. All they have to do is be kind of in line, and that'll be good enough. Think about all the stocks we looked at. Who speaks about the stocks we looked at like this? Right? Think about that. He thinks OCI will grow 49% in the quarter, just shy of 50% growth in the November quarter. Wood notes OCI remains Oracle's key growth driver and finds market trends are becoming more favorable. See what I mean? Nothing but positivity for Oracle. Nothing but positivity, if you read between the lines, in my opinion. Guggenheim Partners analyst maintains a buy rating and $150 target on Oracle shares, but he has some worries about the February quarter. Oh, how do you maintain a buy and one of the highest price targets we've seen, but you have worries? I don't know. This is what I mean. In my mind, this is why I laugh. I just have to laugh at these analysts sometimes. He thinks the company will struggle to hit its financial targets, giving a tough macro backdrop that caused issues in some other software industry earnings reports. But he adds that field checks find a robust pipeline and a favorable future. Even when they try to speak on negatives, they have to reiterate positives and just let you know at how favorable and how positive it is moving forward. This guy's advice, buy the stock on any post-earnings weakness. Yeah, you know why he's saying that? Because last quarter, when they missed earnings and deserved to be down, the market's raging to all-time highs helped propel the stock higher when, in my opinion, it didn't deserve to be there. So now that's why this guy's saying, oh, if they miss and they dip post-earnings, buy the dip. Right? Because if markets are just going to keep climbing no matter what the heck's going on, then yeah, listen, yeah, it might take a 3, 5, 8% hit, but it doesn't matter. It'll eventually come back in the next couple of weeks. Don't worry, you'll be fine. In my opinion, it really makes me laugh. And I'm going to show you these financials here, because again, I'm not completely bashing the stock. We definitely have growth over the years. That cannot be denied. But it's the recent quarters, in my opinion, that are raising a red flag. As you can see, the PE, look at this, over the years was holding the mid-teens there, 17 and change. For 21, almost 30. For 22, almost 35. Just quarterly over the last couple of quarters. Again, they've missed revenue 3 of these last 4 quarters. But the PE has gone up and even maintained itself. It used to be sub 26. Sub 26, then they missed. It went up to almost 29. I think they missed again here. Oh no, Q4 was their best quarter. So it jumped up to 34.5 times earnings. Then they missed here, but it went up to almost 36. Then they missed here, but it maintained 32. How come it's not back down to 26? That's just my opinion. That's where I think it should be. Annually, the company has been doing very well, and you can see here on the annual side, on the revenue side, for 23, estimates of $53.43 billion. However, they just missed the first 2 quarters for 23, right? So now they have to. The other guy was saying, oh, if it's in line, it'll be good enough, right? No, in my opinion, no, because you came in light the first 2 quarters. So now you have to come in above expectations, in my opinion, for earnings today after market close. And you have to come in above expectations next quarter for what you're projecting as well, up there at $14 billion or whatever the number is. Otherwise, you're going to miss on this annual revenue number. And quarterly, again, we can see missing 3 of the last 4 quarters. On the EPS side, the company's been doing very well. Again, 4 years in a row on the annual side, 4 quarters in a row on the EPS side. The debt has jumped up. I mean, it was 50, jumped up to almost 74 billion, and then 87. For 22, it was north of 95. Now, granted, the last couple of quarters, they've got it in check a little bit, and you can see here, 95.3 billion, we'll call it, and then 89, and then slightly below 89 billion. And we can also see the free cash flow went negative this quarter. However, last Q2, they had negative free cash flow as well, and it seems to be less right here, negative 1.59 billion, negative 937 million. So we could say that some metrics are moving in the right direction. Again, it's not a crappy company, in my opinion. I just think it's overvalued. Here for Q1, cash was 11.6 billion for last quarter, down to 8.25 billion. Not necessarily a red flag, just something to note. Liabilities outweighing assets in the short term. Cash flow went negative. So assets, think about a brand name stock like this, right? How long they've been around, how much they've grown. Assets just outpaced liabilities a couple of quarters ago. Assets are now finally above liabilities. Assets minus liabilities yields total equity. We can see now the company has total equity of a whopping 4.3 billion. With the debt still tens of billions, and the book value now finally positive, and as of last quarter is $1.41. Meaning, again, look, we've looked at situations where the stock had negative, right? Who'd we just look at? Box Inc., I believe. Box had negative book value. In my opinion, I thought it was going to go down. They ended up going up. It went from like 27, 28 up to 30 after earnings or whatever it was. So sometimes the book value obviously cannot be the main metric to go on. But again, but basically what I'm trying to say is because the stock has been kept up with this market at these highs, if we really do begin to sell off and chunk down, something like Oracle may start to take a massive hit. And just because it's a brand name that a lot of people know about, you might think it's not justified. However, in my opinion, looking at these numbers, this stock is due for a pullback. Cost of goods has gone from that 2.6 sub 4 billion mark. Now we're well above 4 billion for the last several quarters here. From Q2, yeah, I guess revenue moved in line with the cost of goods, I guess. Revenue minus cost of goods yields gross profit. We can see Q4 seems to be their best quarter. Q3 does look like it does slightly better than Q2. That's why I'm assuming that estimates on the revenue side are now above 13 billion. Gross profit minus operating expenses yields operating income. We can see the operating income has been climbing the last, quarter over quarter from 345 to 375 million. But yeah, technically that is more than Q2 of. See what I mean? It's hard to call. It's hard to call because I'm seeing a lot of numbers that are increasing, and I can understand as to why you want to maybe keep it flat, have it maintain its value. But you can't miss earnings and stay up. You just can't. We have a PE right now of about 31. Yeah, I guess that's pretty much in line with the last several quarters. Price to sales for the last couple of quarters has been above 6. Recently got above 5. Before that was in the 4s. So that again, this in my eyes is a metric that could come back down into the 5s, which is why I'm saying the stock could potentially go down before it goes up here after these earnings. Price to cash flow about 18.5. I guess that's in line. Price to book, now we're only 80 times book. We were 267 times our book value, but now we're slowly coming down in line here. We're only 80 times our book value now. Just imagine all the other stocks that we looked at that have actually been beating earnings consistently. Imagine if all of a sudden they chunked up 70, 80 times their book value. Can you imagine? Return on assets has been climbing. Return on invested capital has been climbing, not as high as it once was. Gross margin up here, 65.25. This is going back Q4, and then this is Q4. So the gross margin was 77.5, and then 1, 2, 3, 4 dropped down over 10% here to 66.7% year over year. This was Q4, their best quarter. Gross margin 77%. A year later, 66%. So of course it might not follow the same trajectory, but we may see another decrease Q4 of this gross margin percentage. And technically it is down from that point. Operating margin sitting here at about 29%. Yeah, I guess that was in line. Same thing though, Q4 over Q4. You can see 2 years ago, almost 39% operating margin for Q4. 1, 2, 3, 4. Q4, operating margin down 31.25%. So that's why, in my eyes, if in their best quarter, some of these main fundamentals are decreasing year over year, how can we keep the stock up? If in their best quarter, a lot of these numbers are going down. Remember, I still say PayPal, perfect example. This is a company that consistently beats on EPS and revenue estimates. And again, if the operating margin is a little shy, they destroy the stock and they bring it from high 60s, low 70s down to 50 and have it hit new 52-week lows, right? This company sees year-over-year decreases in its best quarter in something like its operating margin, misses on revenue 3 of the last 4 quarters, but this stock stays up. This company doesn't hit new 52-week lows, right? Make it make sense. EBITDA, same thing, was 46% here in Q4 and then 42.7%. For the last 2 quarters, it has been increasing. Last quarter up to almost 41%. Technically, it's above average here of the high 30s. This is what I mean. Like, you could make the argument that some of these things are positive. You could make the argument that some of these numbers are trending downward. Net margin percentage sitting at about 19 1/3. Asset turnover was climbing, got up from 0.35 to 0.41, down slightly to 0.39. Yep, these debt ratios are decreasing because now assets have increased. The debt was slightly down quarter over quarter. Dividends being maintained, very nice. And we can see here on the EPS side, the company has been much, much more consistent than on the revenue side as of late. The company missing only twice on the EPS side for the last 8 quarters, missing only once going back to 2015 on the annual side for the EPS side, with profitability forecasted to continue to grow. Looking here on the quarterly side, we can see 3 misses of the last 4 quarters. Up to 14.7 from 13.8. This is what I mean. Q4 really seems to be their best quarter. But if they're not performing for 1, 2, and 3 going into 4, that's what I'm saying. That's my point. That's my argument. You can't keep them up if they keep missing. Annual side, obviously the company extremely consistent. This is why, again, it's hard to call, man. It's hard to call. But in my opinion, I would have to say puts. I really would have to say puts. And of course, I don't have high conviction right now, as you can tell. So, in my opinion, this would be one that I wouldn't even play. But if you guys are involved or you're looking to get involved, obviously I wish you all very well. I hope it works out for you. But again, in my opinion, based off the last couple of quarters, I would have to go puts here. Last Q3 you missed. 3 of the last 4 quarters you missed on revenue. Which means in my opinion, there's a very high chance that they missed this number and, of course, should go down. However, all these analysts are speaking so highly about it without even seeing these numbers yet. The cloud sector the segment has been growing nicely for them, as you see, year over year, 21, 36 billion for 22, north of 41 billion. The services randomly jumped up here, going from the low 3 billion to north of 5.5 billion. The hardware segment has taken a hit, actually. Had a slight bump there from 21 to 22. Okay, that rebounded. That's up. That's up. That's actually down. It's down. It's down. So, and this is what I mean. It's a mixed bag. It's a mixed bag. And if we're just going to look at it as, oh, it's Oracle, oh, it's a cloud computing company, oh, it's going to go higher no matter what, then technically we don't even have to take time to analyze it, right? Because, again, if you're just in the right place at the right time, you are getting rewarded when you technically don't deserve it. Again, the company missed earnings, dropped down, and then went higher than where it was before they missed earnings. I mean, that is impressive. Not many stocks can do that. Looks like we have kind of a symmetrical triangle forming here. So the stock may really not do much. May just bounce around here, $1, $2 here moving forward, and then potentially break about the first week of April, roughly a month from now. But let's look at stock charts very quickly. And you can see here as of late, they've been keeping the stock above this 200-day moving average. Again, even though they've just missed earnings, they've been keeping it up, trending upward, staying above this 200-day moving average. Not even, only once really touching that 50-day. Hasn't really come close. In my opinion, it should break here at 108 even. That is too conservative in my opinion. The stock should be significantly lower in my eyes. RSI here, sub 56 on the daily. MACD recently crossed to the upside. Let's check the weekly here. We can see, look at this, since 2023, just absolutely raging. Dropping down into our consolidated zone, and then chances are it will go higher. Probably. I don't know. We'll see. MACD staying above. RSI on the weekly about 55. I don't know. Yeah, 102. Bottom Bollinger Band here, 102.22 in my opinion, yeah. This 200-day down here in the 80s, in my opinion, that's where the stock should be. In my opinion, that's where the stock should be. I mean, we look at so many other companies. Just remember, if anything is negative, if they came out, they missed on revenue, our stocks take a hit, right? Even look at something like Fubo. Fubo just beat earnings. Said they're still going to make over $1.5 billion in revenue next year, but it's slightly less than what analysts expected, so they beat the stock up. Right, but the little red flags that come out on Oracle, it's not a big deal. We're just gonna kind of bounce it around, keep it up, and just take it up no matter what, because it's a tech stock. I don't know. Like I said, to each their own. Everyone looks at it differently. Everyone analyzes differently. Some people don't even do research. Some people will just pull up an earnings calendar. They'll see something like Oracle reporting today, so they'll jump in, they'll buy calls, just because they know Oracle by name and they feel that chances are, it's probably going to go up and they have a good chance to make money. So again, listen, any of you who are playing this today after market close, I really wish all of you nothing but the best. In my opinion, I have really no conviction other than looking at previous performance. And again, in my eyes, based on how the stock is still basically at this value it was since it's been missing earnings, in my opinion, even if they beat, I wouldn't take them higher. So even if they beat and you want to take it to the top of this range here, this resistance trend line here, that's connecting the tops of February 7, 8, back to this high here of September 11th, 2023. You want to take it to that high of the range, high 115s, 116, before rejecting it back down to 111. In my opinion, fine. As we come and hit this point here, this apex, we technically should break to the downside, not the upside. In my opinion, it should come down to this trend line right here. And I know that's going to be wild, but again, we're talking $87 here in change. And that's why, what was the other 200-day moving average on the weekly? 81. That's why it seems extreme. But in my opinion, it is actually justified. It would actually be justified in my opinion. Because again, overall, 31 PE for a tech stock could be viewed as not too crazily overvalued. And the market cap here, 315. Last year they brought in 50. Right? So they're only trading a little more than like 6 times annual revenue, which again, for a tech company, I can appreciate the fact if people want to make the argument that it's undervalued. But remember, it is only undervalued and should be trading at a higher multiple if it is consistently beating revenue estimates, getting increased price targets, consistently upping and beefing up future forecast and guidance moving forward. And the company has missed on revenue 3 of the last 4 quarters. So it can't be that positive. We can't have that consistency and that beefness and that buffness in the market cap to revenue comparison. And that's why, looking at this current situation, in my opinion, I still say even 6 times last year's revenue is too high for Oracle. And they mention red flags, and then the analyst comes back and says, oh, we don't really see any red flags. I see nothing but positivity. I mean, That's why I don't know how to play it. And just the fact that those articles are speaking so highly about it, in my opinion, I'm that type of guy. I would swim against the stream, and in my opinion, I would probably do some really cheap out of the money puts here. But of course, if you want to be safe, you could always try to straddle the situation. But I wanted to point out this little range here because, again, if they do beat and they want to take it up, it might only be a slight bump here of a point or two. And if they do miss and they want to take them down, again, you're looking at what? Yeah, like 109.5, right? So that's like a 5-point drop. So, of course, your puts would move, but it wouldn't be a massive percentage drop to really show you, like 1,500, 2,000% returns on the puts. So that's why I'm saying, overall, in my opinion, looking at the situation, I personally wouldn't be playing it. If I was forced to take a position, in my opinion, I would go with puts. I just think it's as simple as that. But let me know down in the comments section if you agree, if you strongly disagree, or, if you're involved already, if you're going to take a position in this going into the close. Let us know down in the comments section. I'm very curious to hear how you guys feel about this one as well, because, I don't know, in my opinion, I'm just not seeing it. But I'm going to end it there. So once again, Stocks by the Numbers. Thanks for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, we're volatile, and we're very uncertain. I want to wish all of you success. I hope everyone makes a couple of bucks. Thanks for stopping by. I'll see you guys in the next one.